Alcoa is out of the Dow. PetroChina might be buying up a little bit of Russia, and regulations in California might have serious ramifications for fracking. Thanks for watching. This is Digging for Value. Hi, I'm Allison Southwick, and I am joined by Taylor Muckerman and Joel South, energy analysts here at the Motley Fool. Today we're going to look at some stocks that saw some pops and drops. We're going to also talk about some of our buy, sell, and hold stocks. But first, our top story. Big news today, as Reuters and others are reporting. The Dow has kicked out Alcoa, HP, and Bank of America, and they've replaced it with Nike, Visa, and Goldman Sachs. So Alcoa specifically has been in the Dow for 54 years, and they're getting replaced by Nike. So Taylor, were you surprised by this?
I was. I mean, now we're left with absolutely zero representation from the mining and material sector other than DuPont. So I'm looking at this, scratching my head as to how this is benefiting a representation for an index of the United States economy right now. This is a company that's tied to automotive, aerospace, and packaging, beverages industries as well. So I think that this really represents America, and it's sad to see it go. Now I think the Dow Jones is a little bit too heavily reliant on consumer goods, with Nike taking its spot. You see Coca-Cola in there as well, Ford. So you see a lot of companies in there that don't really cover this sector. So I think that it's underrepresented, and it's a shame to see it go, as it was the bellwether and kicked off earnings every single quarter for the Dow.
Right? Oh, that's true. Earnings season. Like now what are we going to do? We're never going to know when it starts. We're just going to stare at our computer screen and see who's going to be first. Do you think there's going to be a rush now for someone to claim that first to earnings spot?
Yeah, I don't know. You always garner a lot of headlines for it. So it would make sense for somebody to try.
All right. That'll be interesting to see who takes over. All right. And our next story is we're looking at PetroChina is said to study a $10 billion Russia gas investment is the headline today. So Joel, there's been a rumor that PetroChina is going to purchase some gas fields in Russia, and PetroChina has actually been pretty busy lately making interests, buying up interests in properties.
Yeah, definitely. This is China needs a lot of resources, and they're going out and buying them because they can't produce them in-house right now. So it's very interesting. They're going out and looking to buy these or buy interest in this Siberian field, and the reason is they've had ongoing debates with Russia for a number of years. The pricing hasn't been set, so by going over there and actually buying these interests, maybe they can get contracts in place to move that natural gas. However, if you look at the United States companies, PetroChina, or Sinopec, in other words, basically has been really helping out companies. If you look at Apache last week, they've had a lot of these Egyptian assets that have really been holding back their balance or their stock price because of all the turmoil in that area. They went out and put together a $3 billion deal to buy it from Apache. Also Chesapeake, you know, the debt situation they've been in for a number of years. They also had a deal for $1 billion earlier this year, also from Sinopec. And then you can even go back to what Devon Energy did 2.5 years ago. Sinopec came in, joined a joint venture with the company. It really helped them develop 5 really great shale plays for them right now. So by them needing these resources, they're going out to either get the actual resources themselves or get the expertise so they can go home and try to get that, unlock that shell code that the United States have finally been able to do. So it's very interesting to see what they're doing. They're really helping out a lot of United States companies, especially after the land grab and the debt problems that we've had.
Yep.
All right, our next headline and final headline. Over at the Wall Street Journal, scale of West Coast fracking probe. Basically, the Wall Street Journal is reporting that the California Coastal Commission found evidence of offshore fracking conducted by platforms that are overseen by the federal government. And it comes in the wake of some pretty heated legislature that's being argued right now that would regulate fracking. So what should investors be keeping an eye on when it comes to the fight in California right now?
Yeah, they should definitely be watching what actually happens here, because one of the biggest shale plays that has really been untapped is the Monterey Shale. And really, they're looking at 2/3 of the United States resources, shale resources, is in this play. So if you're looking at a lot of state legislature coming out and moving fracking, just similar to what New York has done with the natural gas in the Marcellus, then you're not allowing a lot of these companies to go in. So if you're an investor in EOG Resources, who's one of the biggest hydraulic fracturing and horizontal driller, you know, they're out of this area with potential 15 billion barrels of oil. Yep. So obviously that's huge. Another company that, if you're an investor in, that could really open up a lot of resources is ConocoPhillips. They've basically looked at the lower 48 to create a lot of their oil production and a lot of their growth through the next decade or so. So they're really looking to expand in that area, and this could be a great play for them, very close to what they're already drilling, so that'd be a good acquisition to move right into. And then you could also look at a company like ExxonMobil or Chevron, who basically have been trying to replace the reserve replacements. Their ratios have really been declining because oil fields are harder to come by. So one of this size and of these companies with the balance sheets that could easily jump in there, they really need to watch this regulation, because if it does open up, this could be a huge boon for them, and it fits right in with what they're already drilling. So that could be a big game changer for a lot of these companies.
All right, that covers it for the headlines. Now it's time to take a look at some stocks that are popping and dropping today. So first up, we've got Solar City. They are up 22%. So Taylor, what is behind the pop?
I thought the 13.5% I saw earlier today was big, but now we look at this up over just slightly over 22%. Big news, not just today, but over the last few weeks. Today, though, they signed a deal with Direct Energy to provide up to $124 million in solar financing for some of Direct Energy's business customers. So this is a company that operates in 14 states and Canada. So it's been kind of odd to see a power provider and a solar company partnering together. It's something that you've seen power providers try to go against solar because it's kind of hurting their business. So it's very positive for solar and SunPower as well to see this happen. Solar City getting out of the residential leasing market with this, so I really think this is favorable for this company. Also, they're now signed a deal with East Bridgewater, Massachusetts to provide up to 2.45 megawatts of energy, enough to power 350 homes. That deal's for 25 years, and it could save the town of East Bridgewater a considerable amount of money. So I look for maybe some more deals like this for Solar City, and then you look at their two bigger competitors, First Solar and SunPower, a little bit more integrated, so they could jump on this bandwagon as well.
So do you think they deserve the 22% pop here?
They've struggled recently, so I definitely think that seeing them get into different lines of business is definitely beneficial for shareholders. They've been really tied to the leasing side of things, so this is definitely a positive movement for them.
All right, so our big stock taking a big drop today is Gulfport. They fell about 5%, but they've kind of clawed their way back a little bit. So what happened here?
Yeah, definitely. What they did is they came out and lowered their production guidance. Obviously, anytime that happens, it usually hurts. It shouldn't be as big of a deal for some of these companies, but basically what they did is they're looking about a 15% production decrease from what was already estimated. So obviously, those numbers do hurt a little bit, but if you look at what the well actually is, it's a natural gas well in the Utica, and the holdback was basically the takeaway capacity was constrained. That's been a big issue in the Utica Shale. It's not something that investors should really be focused on, because this is pretty much expected at this time.
All right, so undeserving of the drop?
Yeah, I think the market corrected throughout the day, and rightfully so, because if you look at the contract for the third-party contract that they actually had in place, basically the well's already drilled, the expenses are already there, the actual pipeline is going to be available late October, so this is going to be recorded sales later in the year, so it's just pushing it down a little bit. If you look at all of 2013, production's guidance is the exact same, so this is really having no benefit, or shouldn't be a factor for this company. Overall, investors shouldn't be worried about it, and in the future, if you see some of these Utica holdups, since the capital expenditures are already there, it's going to be recorded, and it shouldn't be a worry. So that 5% should have been a great time for some of these investors to jump in, because that really is a non-factor in this case.
All right, great. Well, that covers it for our poppers and droppers for today. Now we're going to play a little game called Buy, Sell, and Hold. It's our version of Marry, Date, Kill. So I'm going to give you guys 3 stocks in a specific sort of industry, or share some common traits. And you need to tell me which one is your long-term buy, which one is your sexy pick for right now, and then which one you are bearish on, which one you're going to sell. So our version, Marry, Date, Kill. We could have started with the Kardashian sisters, but we're going to go with some stocks, right? All right, so Taylor, I'm going to give you 3 names in agriculture. All right, first one is CF Industries. They're a nitrogen fertilizer producer. Mosaic, another name in fertilizer. And then the last one is going to be Deere and Company, obviously, John Deere.
People know that.
All right,
Should've brought my hat in.
So buy, sell, and hold, those 3 stocks.
Let's see. Buy, I'm going with John Deere. Everyone recognizes this brand. It's the global leader in agricultural products or machinery, really revolutionizing the game. I foresee in the next year or so you can probably operate your entire farm, if you're going to spend top dollar, from your computer. It's just going to be like a computer game. You can control your tractors, your sprinkler systems, the works. So I like this company. They provide a steady dividend around 2.4%. They haven't really even tapped the international market yet, and they've been kind of held back by their construction equipment segment, so I look to see some improvement in that while their agricultural segment continues to thrive. So if both of those get on the same horse together, I look at this company as a very long-term sexy and solid buy. So for my hold, I'm looking at a company, Mosaic. They a little bit more diversified than CF Industries. They #1 phosphate fertilizer producer in the world, and they're also part of the Canpotex cartel in Canada with Potash Corp of Saskatchewan and Agrium. They basically market all of the Canadian potash around the globe. They're obviously the biggest cartel now, that Belarus Potash Corporation has been broken up, much to the blight of the potash producers, who are down pretty significantly over the last couple weeks. So I look at this as kind of a shakeup that was necessary. Happened a little bit quicker than the producers would have liked because they didn't really have time to adapt. But I think now that the lower price of potash is there, buyers are going to reemerge, and you're going to see these as long-term holds just based on the trends in fertilizer. CF Industries, unfortunately, has been really riding the tailwinds of low natural gas here in the United States. I look for that to maybe continue for another year or two, but natural gas exports at the Gulf Coast and probably another couple facilities by 2015 will be announced. So I look for that price to steadily increase and kind of erode some of the pricing competitive advantages that they've had over international peers. So CF Industries is my sell for that reason alone. Mosaic, I like their diversity, and John Deere, you just can't go wrong with them.
That's sexy green.
That's right.
All right, so then, Joel, I'm going to give you 3 natural gas companies. I'm going to give you Chesapeake, Cabot Oil and Gas, and Sandridge Energy.
Those are 3 very interesting companies. 2 of those are actually been moving away from natural gas and trying to get into liquids. The company that I think has the best long-term potential would be Chesapeake Energy. This is a company that's been really beat up. They've had a number of debt issues from the land grabs that they had under previous management. Yep. After Audrey McClendon finally being ousted from the company, I really like what Lawler's doing. He's really been transforming the company. Basically, 85% of their CapEx is now focused in liquids. They're going after the high liquids potential, so they're going after the highest ROI plays. That's really been beneficial for them. They had a killer second quarter, and that's all from that. What they've also done is cut down their debt. They've been selling assets. They even chopped their capital expenditures almost in half throughout the remainder of 2013. So they're making all the right moves. Management's in place. He actually kicked out a lot of the other C-suite earlier, a couple months ago, actually. Yep. So he's really transforming the company, really moving in a different direction, focusing on liquids and really growing it long term. It's still cheap, so as they keep getting those liquids placed, I really like them. Company that I like that I think is pretty sexy right now would be Cabot Oil and Gas. I'm bullish on natural gas and where it's going to go long term. This is a company I'm pretty happy to add to a portfolio for the long term because they are one of the low-cost natural gas producers. If you look at what their finding costs for natural gas for 1,000 cubic feet equivalent, it's about 89 cents, and their real bread and butter is the Marcellus, and the finding cost there is almost half that. So they have about 3,000 drilling locations left in the Marcellus, about 25-year inventory. So as natural gas prices increase, they're already competitive with some of the liquids plays. So being the low-cost producer right now, even at low natural gas prices, they're making money. As that continues to increase, like you mentioned, with some of the exports out of LNG exports, that could really boost. And I think that company is pretty hot right now, and they're trading at pretty good levels as well. One company, I guess, that I would say would be on the sell, although this is a company that I own, so I wouldn't necessarily say sell this company. I still think it has potential, and the last quarter you saw a 20% production growth in the Mississippian Lime, and that's their bread and butter. That's basically where all their money's at. One of the big things for them is they actually lowered their costs, or their well cost, to about $3 million. They were hoping to do that by the end of 2013. They did that early, which was a boon. However, the market was still holding them back because management still is unsure what they're going to do long term. They're saying that if they're going to go and target a lot of these good plays now, but in 2015 they're going to be up against another debt level where if they don't fund that gap, they could be in trouble where they're going to have to either go into joint ventures or sell assets. And anytime that's the case, that's really what hurt Chesapeake over the last few years. Mm-hmm. Not having that certain future is something that really you have to focus on this company and really not be sure if you can actually jump in right now. It is cheap, which is very nice, but that 2015 marker is still really questionable, and uncertainty always hurts the share price.
Yeah,
so.
Moving large.
Right. All right. Well, I think that covers it for us for today.
I hope so.
You're all talked out. On behalf of Taylor Muckerman and Joel South, I'm Allison Southwick. Thanks for watching.